The second element of the SMILE test is valuation. It's not the first element. We don't do screens and try to buy cheap stocks. We're investing in good businesses. However, in order to do well over time for your clients, we believe we need to select the time of that investment when others in the marketplace don't necessarily see what we see in a business. As we discussed earlier, is neither the beginning nor the end point of what we do. But it is important because we're not going to invest in businesses that we believe are overvalued. One of the things that we talk about is, what do we believe we know that others don't? So there are examples of great businesses, great companies, Google comes to mind, others such as that we don't have investments in. We don't have investments in these businesses primarily because we don't see where we have a competitive advantage in terms of information about the business or where the business is headed relative to others who are following this particular company. When we don't believe we have an advantage over seeing something different from others, it might be a great business, but we most likely won't invest. When we talk about valuation, we often use the term private equity in the public markets. What does that mean? Using Warren Buffett as an example, Warren Buffett also often buys entireties of business. He values these businesses typically based on cash flows and pays a value that he believes is appropriate for the cash flows that these businesses generate throughout market cycles. We take the same kind of approach. We often use a valuation methodology which we term cash flow return on economic value. What that does, very simply, is it takes the entirety of the cash flows of a business as if we owned and controlled the entirety of the enterprise, and it returns it to shareholders. If we own the entirety of the business, then 100% of the cash flows are returned to us. We then do an analysis, assuming that we then have those cash flows, and what we had to pay for those cash flows. You divide one into another and you have a simple percent. That number could be 13 or 15%, depending on the company we're talking about. And we could compare that to what a knowledgeable private equity investor would pay for the cash flows of this business. That number may differ based on volatility in earnings, type of business, sustainability of business, age of business, and generally our conviction level that these companies are going to return those cash flows to the owners, namely us in this particular case. The gap between what a knowledgeable investor would pay and what the equity is currently trading at in the marketplace today is the difference between required return and CFROEV. If you did an inverse of that, you would come up with an estimate of the intrinsic value of the enterprise, which is often what we use to gauge whether a particular stock is attractive for investment purposes.